What is going on YouTube? It's Sankey and we're back with another one. Alright guys, so in this video I'm coming at you with a couple more stocks for you guys to consider adding to your portfolios. Right now is earnings season for a lot of companies, and as you guys might know, one of the biggest catalysts to push that stock price up is the reporting of good financials. So I want to make sure these plays are on your radar. You guys know I'm your eyes and ears when it comes to the stock market, always looking for the best plays out there. Now guys, before I get to it, I'm going to need you guys to hit that like button for me, and if you're new, hit that subscribe button, join the journey. Now our time has finally come. Let's jump into our first one. Up first, we have Snap sitting just below $53. Now this is the high growth, super engaging social media / camera company. As I always say to you guys, the best time to enter into these plays is before they've run up. We're looking for those growth plays that are currently in consolidation mode. Now over here, you guys know we don't chase those stocks that have run up. We'll catch them when they dip. But in the meantime, we're going to look for the next rocket before it takes off. That being said, let's take a look at the charts. Follow along with me. So on the 1 year chart, you can see explosive growth in that Snap stock, and there's a real potential for this stock price to jump up. So in October, we've gone from high 20s right up to low 40s. So this ticks the box that it's a solid growth candidate. So if we now zoom into that 3-month chart, you can see that since early December, this Snap stock has been consolidating around the low $50. Now guys, there's not been too much price action since then, but this is a good sign, because when you see that growth candidate that's showing signs of consolidation, it's almost as if the investors are waiting patiently for the next catalyst to come along and push that share price up. And that could come in the form of Snap's earnings, which are coming out on Thursday, the 4th of February, this week after markets close. So I want to make sure you guys have that in your calendar. Now there's a couple of things I like about this play that I want to put on your radar. There are forecasts for explosive growth in their financials that are being released this week, anywhere from 40% to 70% year on year in their fourth quarter. And that will take their full year 2020 revenue to somewhere in the region of $2.5 billion. So guys, this explosive growth is going to be good for its stock price. I want you guys to keep your eyes peeled on this Snap play. Long term, they're forecasting revenues of 10 billion by 2025, so the potential to 4x on this one. As I always say, you want to keep your eyes peeled on those plays that go out there and make those acquisitions, because that's one of the fastest ways to grow and diversify your business. And here we have it. With this Snap play, they've made 2 acquisitions in January month alone. The first is a company called StreetCred, and they're a location data business. The second is a company called Aerial AI, and this is going to improve Snap's augmented reality capabilities. Now guys, this is a very good sign to see, and I do think this is what's going to keep Snap growing for years to come, and I do expect more acquisitions as we go through this year. Now Wall Street agrees with us on this one. We have Wells Fargo that has a price target of $62 on this play, and I do think if Snap are able to post good financials come this Thursday, I do see the potential to well surpass that $62 mark this year. So this could be a good growth candidate to add to your portfolios. Guys, let's talk strike price on our Snap play. If you can catch this play under $51, remember earnings are this Thursday, so there's not too many days left. Do consider adding this one to your portfolio. Up next, that's Pinterest, ticker symbol PINS, another fast growth social play. Let's take a quick look at the charts. As you can see on the 1 year chart, explosive growth right throughout the year. Reminds you of Snap. On the 3-month chart, again, you can see that consolidation pattern, this time a bit further out, starting from the end of November. Now guys, this is the kind of signs that you want to spot in these plays, that solid consolidation within these growth plays. Now, unlike a lot of other social platforms, Pinterest are nowhere near their peak. There's a lot more room for this company to run up. Got to remember, there's a huge international expansion piece for this business, and also the potential to roll out their e-commerce within their platform. So there's good things for this company to come. So this is another play ahead of earnings that I want you guys to keep your eyes on. Right now at $68, they're in the buy zone. So consider adding this one to your portfolios. Let's jump to the next. Now our next play isn't releasing earnings this week, but I want to make sure they are on your radar because they're looking like they're set for some explosive growth. We have HYRE, that's ticker symbol HYRE, currently standing at $9.91. HYRE is a car sharing platform which allows you to earn money from your car when it's sitting idle. You just list it on the platform, someone comes and rents your car, and then they pay a fee. Now there's a couple of things I like about this play that I want to put on your radar that make them a good potential for our portfolios. The first is not only did this company grow 50% during the pandemic with 3,000 vehicles, they've made a partnership with a couple of companies, one called AmeriDrive, one called Cogent, to give them the funding, the assets they need to expand their vehicle base, adding 6,000 vehicles, meaning they have 9,000 in total. Guys, this would then increase their revenue this year by 92% to 44 million. This is some explosive growth in this stock. Now you guys know we have to do a check on their valuation, sitting at sub 200 million market cap with 44 million in revenue forecast this year. This gives them a price to sales of around 4 times. Now, for a fast growing business, price to sales of 4 times is looking like a cheap entry point for this play. That's want to make sure they're on your radar now. Now, Wall Street also agrees with us on this one. Analysts are getting more and more bullish on this play. I've seen price targets at the high end of $18 on this play. So guys, there's a potential to double your money on more on HYRE if they can fulfill their business mission this year. Now let's take a quick look at the charts. As you can see on the 3-month, nice increase in that stock price. This is where it gets interesting. If we look at the 1-week chart, this stock increased 25%. Bear in mind, we've come out of a very volatile week. Not many stocks are able to increase, let alone increase 25%. So it just shows you the strength of this play going forward. Alright guys, so let's talk strike price on our new HYRE play. I've set that at $10. If you can catch them under $10, consider joining us on this play and adding HYRE to your portfolios. Alright guys, if you've been rocking with the channel, you know what time it is. This question comes from Lola. She says, how do I reduce my average price? So this is a great question. Now, firstly, you guys know I always set my strike prices on our plays for you. And when I do, I take into account a lot of different things. I'm looking at their upcoming catalysts. I'm looking at how volatile that stock is going to be in the short term. And also I'm looking at their valuation to see if they're cheap or expensive at that given time. And there's room for that price to come down. This is going to give you a better entry point, and it gives you a better chance of jumping into this play and for them to start rising rather than taking a short-term dip before that stock starts rising again. Now, once you're already in a play, the way to lower your average price is to buy that stock again at a lower price than when you originally bought the stock at. So therefore, you have to wait for a dip in that stock. Now, we've just come out of a very volatile week in the stock market, and there should be some good opportunities for you guys to load up on some plays and average down because they've dropped down. So this is a good time to talk about portfolio diversification. I always say keep your portfolios well diversified, but to a point that you can keep track on your stocks. So keep the number of stocks at a number that you can comfortably manage. So therefore you can spot when the dips are in those stocks, and then you can load up on those plays. If you have too many that's out of your control, you're not going to be able to load up on the plays when they've dipped. Now do remember, it's not all about averaging down. Sometimes averaging up can be good also. If you take a play that you're long in and you believe to continually grow, like a Neo for example, averaging up can be a good thing because over time you're building wealth and accumulating and growing your returns as Neo grows. Because it's Monday and I received a lot of questions from you guys over the weekend, we're going to go in again. There's questions from Roger. He says, when is it a good time to sell DSG? Now I thought this was a great question. My 2 cents on this doesn't just apply to DSG, it can apply to all of our penny stock plays. But with regards to DSG, what we're waiting for is some good financials to show that management are on track to hit that 60 million in revenue, and that will push that stock price up. Now what's likely to happen is you're going to see a run up in that DSG stock price. Following that, you're going to see a sell off, and it's going to come back down and settle to a point that's higher than where it's at now. Now guys, how many times have you seen that price action with these penny stocks where they run up and they come back down? We're talking 30-40%. Now a good strategy for these penny stock plays is to recognize the run up, sell out at the top, or sell out a portion of your holding at the top when that stock dips back down, and if you believe in the stock long term, you can rebuy again. Now this just prevents you holding that stock through the downward volatility that follows the run up. As always, thanks for tuning in. Do drop me a like and a comment, and if you're new, hit that subscribe button, join the journey, and I'll catch you guys in the next one.